Congratulate yourself for all conventional definitions of success. The market blinks green, headlines report record growth, and you just received your annual salary increase. The system praises you, but you are missing the larger picture. In a quiet, glass-walled office in a city that doesn't sleep, a complex mathematical formula, invisible to the untrained eye, is working against you. This formula doesn't care about your promotion, your hard work, or your ambition. It isn't a conspiracy, it's an economic necessity disguised as a convenience. And the simple, devastating truth is that the system you operate in is designed to transfer wealth from those who don't understand how it works to those who do. The old, linear path, study hard, secure a job, and save money, isn't just a quaint relic of the past, it is dangerous advice in the 2020s. Right now, a subtle geopolitical geometry is restructuring your reality. And if you cannot see the architecture, you are already paying an invisible tax. We are living through a massive structural shift in how capital flows globally. Yet most people are still operating on rules from 1971. That was the year currency stopped being backed by anything tangible and became purely a function of debt and geopolitical confidence. When currency is devalued through inflation, which is a structural feature, not a bug of the modern economic grid, the value of your labor is devalued simultaneously. You observe prices rising and attribute it to corporate greed or supply chain issues. You might be right, but you are missing the larger picture. In a debt-based system, savers are losers because inflation erodes the purchasing power of cash sitting inert. And the stakes have never been higher. With global markets increasingly interconnected and volatile and the social safety net fraying, financial literacy is no longer a luxury, it is the boundary line between economic sovereignty and debt dependency. It is the fundamental skill set required to navigate a world that wants you to remain an impulsive, high-velocity consumer. To understand the stakes, we must observe the system's impact on two identical subjects starting their careers on the 44th floor of a glass tower in Midtown Manhattan. They both earn $110,000. They have the same intelligence, ambition, and work ethic. The only variable is their perception of the map they have been given. Observe person A. He understands how to generate active income. He is a high performer. He believes success is a linear projection. Earn more, spend more. He gets that first bonus and upgrades his lifestyle. A better apartment on floor 31. A luxury car lease, $850 a month because he deserves it. He looks successful. He is, to all outward observers, living the dream. But A is a passive participant in the machine. He is confusing liabilities with assets. He thinks he is a homeowner when he is a mortgage holder. He is operating on a purely transactional level, trading his finite time for currency, not realizing that he is just one recession, one layoff, or one health crisis away from collapse. He is not accumulating optionality, he is accumulating obligations. Person B gets the same bonus. To her colleagues, she looks like she is falling behind. She drives a 4-year-old car that she owns outright. She lives in a modest apartment. The difference is that person B sees a separate layer of reality. She doesn't have a saving problem, she has an accumulation strategy. She understands a fundamental rule of advanced economies. Wealth is what you do not spend. Person B understands the invisible geography of the tax code and the power of legal leverage. When person A works an hour and earns $100, the government immediately claims a substantial portion. When person B invests her bonus into an asset, like a diversified portfolio of productive businesses, that asset generates income that is taxed far lighter than person A's labor. The tax code is not an academic exercise, it is an incentive system designed to reward those who provide capital over those who provide labor. Furthermore, person B knows about leverage, but not the consumer debt A uses. She sees real estate not just as a place to live, but as collateral quality.
While A is leveraged 10 to 1 on his lifestyle, B secures a lending facility against her portfolio at 3% annually, borrowing liquidity into existence to fund her next acquisition, without triggering a taxable event. A is trapped in the active income loop. B is building a lattice of compounding assets that support one another. Person A is an emotional market participant. He sees stock charts on social media and tries to day trade his way to person B's level by taking immense risk with a complete lack of psychological control. He sees volatility as an opportunity for get-rich-quick schemes, but he lacks the structure to handle a downturn. When the market drops 20% on a Tuesday morning, he panics. He buys the hype at the top and sells in terror at the bottom, exactly when institutions are accumulating the assets he just liquidated. Person B understands that volatility is the price of admission for superior returns, not a reason to abandon the structure. When the market drops, she buys more, because she knows that the wealthy do not sell their productive assets during a crash. They use the cash flow that their lattice generates to purchase more collateral while it is undervalued. The great uncoupling in modern finance isn't between the rich and poor. It's between those who perceive assets as claims on future productivity and those who see them as gambling vehicles. A seeks dopamine hits, B seeks durable income. Zoom out 20 years. A is trapped on the high-salary treadmill. He has lifestyle creep, a dependency on active income, and high stress. He physically cannot stop working because the entire machine he built requires that monthly $110,000, lubricating it just to avoid default. He realizes too late that the Floor 31 apartment and the $850 car payment were not purchases, they were trades. He traded decades of his future freedom for temporary comfort. He is an essential dependent node in the institutional grid, incapable of existing outside of it. Person B is a sovereign entity within that grid. Her investment income from decades of calculated code utilization and risk management now dwarfs her salary. She doesn't have an employment problem, she has optionality. She doesn't check the market every day for an emotional read, she checks it for strategic positioning. Financial literacy didn't moralize her life or make her smarter. It unlocked her time. She is 45, and her future is entirely her own. She can pursue a new venture, retire, or do nothing. Her identity is not restructured around the machine. Her identity owns the machine. The fundamental transfer of capital from person A to person B happens silently, relentlessly, every single day. The old advice, passed down by generations who operated on a gold standard, is designed for a world that no longer exists. The system relies on a steady supply of active income from person A and the billions like him to fund the compound growth of person B. You can master the chemistry and history you are taught in school, but the most important skill set, the one required to navigate the reality of ownership and dependency, is never formally disclosed. The rules of the economic grid are not complex, but they are hidden. Right now, a 23-year-old analyst is logging in to a terminal for the first time, convinced that success is about hard work and ambition. He thinks he is entering a career, completely unaware that he is stepping into a system with gravity that has already calculated the cost of his non-expert perceptions. The final geometry is not subtle, but the uncomfortable question that remains is, even when the map is revealed, why do most people still choose to remain lost? This visual explorer allows you to compare the financial architecture of person A versus person B over their entire 20-year journey. Watch how subtle decisions about lifestyle, taxation, and market interaction compound, transforming person A into a dependent node and person B into a sovereign entity, all fueled by the same $110,000 initial income.